What if I told you the money in your bank account isn't really real? You probably think the government prints it, but the shocking truth is that over 90% of all money is created the instant a private bank issues a loan. It's not printed, it's typed into existence on a computer screen. It is born as debt. This isn't some fringe theory. The Bank of England confirmed it in a landmark 2014 report, stating that bank lending creates new money. Once you grasp this one concept, the entire financial world shifts. You'll stop seeing the system as some confusing force working against you and start seeing it as a set of rules. And once you know the rules, you can start to win the game. 1. The myth we all believe. Before we get to how the system actually works, we need to tear down the myth most of us believe. I call it the money warehouse myth. The story goes like this. A bank is just a safe place to store money. You deposit your paycheck, and the bank acts as a responsible middleman. It takes your savings and lends them out to someone who needs a mortgage or a business loan, making its profit on the interest rate spread. In this story, the bank is a passive vault. The amount it can lend is tied directly to how much savers have deposited. It's the story from It's a Wonderful Life, where the town's savings directly fund new homes. This belief is comforting. It feels fair. It suggests saving is the foundation of the system. The problem? It's just not true. Banks aren't just passing around pre-existing money. They are creating new money. So if banks aren't warehouses for money, what are they? We're about to dive into the secret origin story of modern money. If you want to keep learning how the financial world really operates, hit that subscribe button now so you don't miss what's coming next. 2. The Goldsmith Secret, the birth of modern money. To see how we got here, let's take a trip back to the 17th century Europe. Long before digital dollars, the world ran on gold and silver. Imagine you're a merchant. Carrying bags of gold is dangerous. Luckily, the local goldsmith has the best vaults in town. For a fee, he'll store your gold and give you a paper receipt, an IOU, for your deposit. Soon, everyone realizes it's easier to trade the paper receipts instead of hauling around physical gold. These receipts are as good as gold. They become the new paper money. And this is where the world changes. The goldsmith notices that the vast majority of people never come to redeem their gold at the same time. On any given day, maybe only 10% of the gold is actually claimed. An idea sparks. What if he issued more receipts than the gold he actually has? He could lend these new, unbacked receipts to people and charge them interest. Who would know? As long as everyone doesn't show up at once asking for their gold, a run on the bank, the illusion holds. A farmer needs a loan. The goldsmith doesn't give him gold coins. He just hands him a freshly printed paper receipt, a promise for gold that doesn't exist in the vault. That piece of paper is, for all practical purposes, new money. The goldsmith has just created money, not from metal, but from debt. He created it from thin air. This was the birth of fractional reserve banking. The goldsmith's secret is the blueprint for our entire global financial system. He discovered money could be created based not on the asset he held, but on the public's confidence in him. 3. The modern connection from goldsmiths to digital dollars. Let's fast forward to today. The gold standard is long gone, and money is just a series of ones and zeros. But the goldsmith's secret is more powerful than ever. Today's commercial banks, Chase, Bank of America, Wells Fargo, are the new goldsmiths. And the digital dollars in your account? They're the new paper receipts. When you go to a bank for a $500,000 mortgage, the bank does not check its vault for other people's savings. With a few keystrokes, the bank does two things at once. First, it creates a new asset for itself, your $500,000 loan agreement. Second, it creates a brand new liability, a $500,000 deposit in your bank account. Poof. $500,000 of new money was just created. It didn't exist a second before you signed the papers. As the Bank of England confirmed, bank lending creates deposits, not the other way around. Think about what this means. The vast majority of our money is created by private, for-profit corporations every time they issue a loan. And here's a fascinating wrinkle. They create the principal of the loan, but they don't create the money needed to pay the interest. This sets up a wild dynamic at the heart of our economy. 4. The so what, the debt imperative, and the inflation engine. You might be thinking, okay, weird trivia, but why does this matter to me? It matters because this is the hidden engine behind the rising cost of living and the boom and bust cycles that affect your wallet. Let's go back to that loan. The bank created the $500,000 principal, but over 30 years, you might have to pay back $900,000. Where is that extra $400,000 for the interest supposed to come from? It has to come from the rest of the economy. For the system as a whole to function, that money must be created through more loans being made to other people. This creates a powerful systemic bias. For today's debts to be repaid with interest, there must be a greater amount of debt taken on tomorrow. The total money supply, which is mostly debt, has to keep expanding. If lending slows down or if people pay off debt faster than new loans are made, money disappears from the system. That can lead to a deflationary spiral of defaults and economic collapse. This is why you always hear politicians and economists obsessing over growth. Our system doesn't just prefer growth, it has a deep-seated need for it. An economy built on debt money is like a shark. It has to keep moving forward or it dies. This is also a primary driver of persistent inflation. When the money supply expands faster than the goods and services being produced, each dollar buys a little less. Your purchasing power goes down. That loaf of bread isn't necessarily more valuable. Your dollar is simply worth less. This isn't a sign the system is broken, it's a direct consequence of its design. If you're still with me, you're starting to see the matrix. This is the single most important concept about money. If you're finding this valuable, hit that subscribe button. It helps more people discover how this all really works. 5. The pivot. How to stop fighting and start winning. Understanding this can feel bleak, like the game is rigged to keep people in debt. But despair is not a strategy. The truth is only useful if it gives you the power to act. When you accept that money is created from debt, you can stop fighting the current and start using it to your advantage. You can finally see the huge difference between good debt and bad debt. Bad debt is what the system pushes on most people, debt for consumption. It's the credit card for a new TV or the loan for a car that's losing value every day. With bad debt, you are the fuel. You're working to pay interest that makes the bank richer, with nothing to show for it but a depreciating object. Good debt is how the wealthy play. Good debt is borrowing money to buy assets that either appreciate or produce cash flow. It's using the bank's own magic trick for your benefit. Think about it. You get a mortgage to buy a rental property. You're using newly created money to buy a real asset. That house generates rental income, which pays back the loan and the interest, and you hopefully keep the difference. Plus, you benefit from the property appreciating over time, an appreciation often fueled by the very inflation the system creates. You are using the bank's ability to create money out of thin air to buy a real thing that puts money in your pocket. The question isn't, is debt bad? The question is, am I using this tool to make myself richer or poorer? 6. The rule makers, the role of government and central banks. If commercial banks are creating all the money, what do the government and central banks like the Fed even do? They are the referees of the game. They don't create most of the money, but they set the rules that influence its creation. They have a few main tools. First, policy interest rates. The central bank sets a key rate that influences borrowing costs across the economy. Lowering it speeds up money creation, raising it slows it down. Second, capital requirements. Regulators set rules on how much of its own capital a bank must hold. This acts as a safety buffer and a speed limit on how much money a bank can create. Third, government deficit spending. When the government spends more than it taxes, it issues bonds. When banks buy these bonds, it's another form of lending that injects more money into the system. So while the government isn't at the printing press, its policies create the entire environment for the private banks. The central bank's job is to keep this money creation engine from stalling into a crash or redlining into hyperinflation. It's an incredibly delicate balancing act. Conclusion. We've gone from a goldsmith's vault to the digital ledgers of today. Through it all, one concept holds true. Money isn't a thing made by the government, it's an accounting entry, born from debt created by private banks. Our economy needs constant growth, fueled by ever-increasing debt. This creates a constant inflationary wind, slowly eroding the value of cash. But it is also a system with rules. Understanding this is the red pill of personal finance. It's the moment you see the world as it actually is. This knowledge isn't a reason to panic, it's a reason to have a strategy. It's the key to understanding why hoarding cash is a long-term losing game, and why using debt to buy productive assets is how real wealth is built. You now know the most important rule of the game. The question is, what are you going to do about it? If this video changed how you think about money, subscribe and hit the notification bell. We're just getting started.